for a look at the big market maker positioning and impact on levels in the S&P 500. We got some fresh open interest positions here to start our week, KG.
Yeah, if you actually look at the distribution on the histogram chart for this week to start off, at least, there's a lot of thin structure that's taking place here, Oliver, but some key areas to kind of focus on. We've been talking about this 5,600 level as that negative gamma level for dealers, and that continues to take place when you're looking at open interest. But I did actually move the positive gamma level, or that positive dealer pressure level, down to the downside here to 5,650. And that's because of the fact that we've just seen a lot of compressed markets over the last couple of trading sessions, really trying to fade that 5,630 level. And so now we see some new positioning, just getting a little bit closer, getting a little bit tighter. And for today, we've been in that range for the most part. I mean, we're looking at 5,600 for the most part. We actually got really close to it, bounced right off of it. And we had faded the 5,651 level, at least on an intraday basis. What you would like to see throughout the week is trying to grind higher, hit that 5,700 level. That would be near, or actually at all-time highs. And that would be a win for the bulls. Unfortunately, when you're looking at that chart structure that we have there for the open interest, you do have this head and shoulder pattern that is kind of taking place, and we're really testing it right now. So through the close, you kind of want to break above that right shoulder there to give bulls confidence that this is going to stay intact. If not, and we do see a failure, below that 5,600 level, I would say kind of look out below, because once again, there's a pretty significant gap between 5,600 and that next level that we're going to see, which is going to be around 5,550.
Okay, kind of a tough little pattern there, right? Head and shoulders right in the middle of kind of a dealer pressure level. It's going to take some work, I guess.
Exactly. So this is going to be a battle. And actually, if you kind of look at that chart, I mean, it goes back 5 days. And so since Wednesday of last week, we really have been battling between both that 5,630 level and that 5,600 level, and we haven't been able to break out. Now, you can say that's a consolidation pattern. Maybe we are just trying to figure out the right price and the right valuation for the market at this moment. Maybe we have to digest some information before we can actually move higher. But the longer that we kind of stay in this compressed type of range here, especially when you're seeing down volume actually increasing, at least for today, when you're looking at the down ticks, you have to have a little bit of caution there, because when you're looking at a 1-year daily chart, it does appear that we could be forming a double top pattern where we could actually fail and try to test those near-term lows that we had around 2 weeks ago.
And the context, of course, today being that the NASDAQ is making a lower low than last week. So the NASDAQ's just kind of like rolling over a little bit to some degree after we made lower highs. Now we're making lower lows. So S&P head and shoulders, even though it's not ideal, hasn't broken the way NASDAQ does. Kind of suggests maybe it could. So then if we look at the open interest levels, KG, like if we do get more rollover in S&Ps like we're getting in the NASDAQ, where are the key support levels? Maybe we start our conversation there.
Yeah, so the key support obviously is going to be 5,600, and actually, when you're looking at this distribution, it's 5,690 or 5,590 to 5,600. So you're kind of like your sell-off trigger level would be 5,590 if you're looking at the S&P 500. But if you notice, there's literally nothing under that. So there's really no support structure there, and that's what you get a little bit concerned about, especially when you have a low VIX. VVIX, for the most part, continues to stay elevated. It's not moving in the same fashion as the VIX right now. And so when you kind of break it down, you're looking at 50 to 75 point gaps to the downside there. Whereas the upside, if we actually had more room on this open interest chart, that 5,700 level would show up. It's just not showing up on there right now. And once again, throughout the week, this is going to fill out. We're going to have new trades being placed. We're going to have new hedges being put in the market. We have PCE, we have initial claims, we have GDP. There's enough there to make the appetite for hedging and also speculative upside flows possible, but it is a little bit concerning that it's this anemic starting off the week. And that's one thing to just kind of highlight here. It'll fill itself out, but the downside risk that we have, if we do break these key levels, the downside risk could be another 50, 75 points. Then we can hit another level, and then there's another 50 to 75 point gap to the downside. That is not a good environment for us to be in. We want to continue to move higher, keep breaking those highs, and unfortunately, I mean, it does look like the put side, at least for Thursday and Friday of last week, those that have been getting into those hedges, hedges have been picking those up a little bit more than what we've been seeing on upside sells when it comes to calls.
Understood. Okay, now, Kevin, at the same time as seems like dealer participation is a little bit light, a little bit lower liquidity, it seems like our other measures of kind of similar effects, right? The CME liquidity kind of contracting a little bit, so we're thinning out a tad in this area?
Yeah, and it's nothing to be too concerned about yet, but if the trend continues, this is going to be the fourth trading day where we actually see this trend. If this trend continues, then what you should expect is a gap market where you have these wild swings and intraday swings of 15 or 20 points in a matter of 5 minutes. Those are really not healthy. That is actually another signal that we might be seeing a near-term top, or we might not have enough buyers stepping into this market. If we put it into context, Monday of last week compared to where we are at right now, it's around a 40% drop when it comes to liquidity. Last week, we were sitting at around 45 to 47 contracts on the bid and ask on average. Right now, we're sitting at around 27. If that trend continues and we start getting the 20 and 18, that's where you probably could say, all right, well, I need to be a little bit more cautious here. This is more than just seasonality. And we could actually see the same type of trend happen on this chart. Obviously, 2 weeks ago, 3 weeks ago, we started seeing liquidity draw down actually before we saw the market sell off. And so this is kind of a leading indicator, a complementary indicator of a near-term weakness in the market. There's a lot of bull cases out there. I would say this is more of a bear case to be watchful on.
All right. Sounds like this start to the week could have gone a little better. NASDAQ fading, S&P's dragged. Liquidity kind of coming a little bit light to start the week, and possible head and shoulders that we got to battle through with some resistance ahead. Thanks, KG. All right, good luck here. And S&P's start to